Welcome to the Conquer Risk podcast. Manish, it's something that obviously it's this time of year, right, where we've created our fact sheets, right? Everybody has to do that sort of thing, and
That is that
you
is
had
a
written a blog.
weak intro. You don't want to tell him? I mean, that's the worst you've ever
All right,
done.
all right.
Let's start again.
Watch
All right,
this.
go.
What the hell do people care about calendar year returns? Why is it the first question I get asked almost every time I get a call is, "What'd you do last year?" Right? That's the topic that you wrote a blog post on recently, calendar year returns, and the dangers of. Well, that's what we're going to talk about because clearly we struck a nerve with that. And from this stage, yes, we have to create calendar year return information on our fact sheets, along with the trailing year and some other statistics like max drawdown. But this is a subject that falls a little bit in kin with the how to find a good manager discussion as well. So yeah, I know this is a pet peeve of yours. Tell me a little bit about why you find calendar year returns
Hold
to
on,
be
but
an annoying.
we don't have to. We I don't know if you recall, but we used to. Actually, prior to you coming here, we had monthly returns and calendar year returns listed on the fact sheet, and then we would get questions like what happened in September of 2004 hypothetically or whatever, and it got to the point where we were like, just why are we answering these questions? Like, why do we have monthly or annual? So we took it off, and I remember when we were working together at your prior firm, you're like, hey,
Right.
you got questions about it, and I was just like trying to like duck and hide and avoid answering it. But the point is, like, people kept asking. So we decided finally to put it back on.
Yeah, I think part of and again, it's a pet peeve for both of us really. Part of my issue isn't that the question is asked, because I think the question is valid as long as it comes with some other questions as well. Right? And it's not about us trying to hide from a particular return or a portfolio or anything like that. It's a matter of the questions that don't get asked are things like, well, how did you do relative to the benchmark you're trying to get to, or the objective, right? Or telling us that you have an objective and asking us, do we have anything that might fit in that situation? How did you get to what you did? Did you deviate from your process to get that return? These are all questions that don't typically get asked. It's how did you do last year, because something, a coronavirus, a Christmas meltdown, a whatever happened, and they want to see how we did for that little itty bitty short term period. And
You
without
also
any
know
follow up,
it's a red flag because it's a performance chasing red flag when the first question is, well, how are you doing so far this year, or how you did last year, and it's such an arbitrary number. It's essentially meaningless.
Well, what I find funny is I will occasionally get an email through our website, right? Like, can you give me the fact sheet for X? Or what's the return for, how did you do last year in a particular portfolio? And I have a number of times responded with, I'd love to talk to you about that. Here's a link, schedule some time and I'll provide the information and such and such. And most advisors don't want to have any part of that. Just give me the damn fact sheet.
Yeah.
Like the numbers tell you everything you need to know. I'd say if you look on a dating app, if you just want a girl who's 5'4", is that the end marker? You don't want to know anything else about her.
Well, that's sort of the red flag with this. And a great example is the 2018-19 experience, right? We ended the year with that 20% decline, and if you are a risk manager, you hopefully put some protections in place to mitigate from that. And then the bottom of that 20% decline was, I think, January 4th. So you perfectly lined up the bottom of a 20% decline with what ended up being a 31% year, a rally from there, right? But most of that year you actually spent making up for that 20% decline. So this is where the annual returns start messing with people's minds, because let's say that you were positive in 2018 or protected or went out, and then you were late to get back in. Not late, but that's part of your process. So now you have...
That's the key right there. It's
the
part of the process.
So now you have 1 year, which started at a bottom that, You may or may not be trailing if you're a risk manager, and then the flip side. So it's just so arbitrary, to look at anything on a calendar year basis. But we consistently get calls, so we figure, we're here not to, talk shit. We just want to help people and understand that this is not the best way to look at any investment, right?
Right. And I will say that there is a caveat. I do understand, and I actually enjoy when I get somebody who calls and will say, ask about 2 or 3 different years relative to they're trying to understand the experience. If you ask me how we did on something in 2008 and 2000, 2001, and you've got 2 or 3 different periods, then I'm okay with that, because I can tell that you're starting to try and understand what the process is and the experience. And we've talked about that before. But that's more often than not, 90% of the time, it's what'd you do last year.
And that's the questions are like, as a risk manager, like, what'd you do in 2008? And I'm like, who cares? Like, well, how about before and after, high to low, 3, 5, 10. Right. And so I want to touch on an actual example. And I always bring this up. You and I talk about this all the time with Berkshire Hathaway. Right? Yep. Warren Buffett is arguably considered one of the best investors of all time. People have different opinions on that, but let's assume that he's one of the better, right? Top 10 investors of all time.
Yeah, I'd go with that.
You look back, he was famously, he's a value guy, and the tech bubble or the valuations got insane for him. And in 1999, let me get these actual stats. 1999, Berkshire Hathaway was down roughly 22%, with the S&P up 20%. Now, if you just take that year in isolation as your due diligence method, you would likely avoid that stock, right? The year before...
time out. There is no likely.
Okay,
nobody in their right mind who looks at what'd you do last year would say, oh, no, I get it. It's part of his process. Don't worry about it. They're down 20 and the market's up 20. My clients are good with that, because I tell them to just stay invested. It's okay.
Yeah. Well, all right. That doesn't happen. All right. Well, so the year before, they're up 52 with the S&P 28. The following year, in 2000, they're up 28 with the S&P down 10. And so within that 3-year period, there's obviously outperformance of the S&P, and the S&P is their benchmark. And the point is, like, you just can't take 1 year in isolation and decide to make your decision on whether you're going to use that investment product, stock, mutual fund, or whatever it may be.
Yeah, no, I completely agree. And, it's that way with a lot of things. Look, it's not our product and Warren Buffett's product. It's that concept overall is you're going to do a lot better if you understand the process. That'll help you understand the product and what the objective is. And then some of these individual spots, start to make sense. Because again, it's all about the better the client experience, the more likely the client is to stay engaged. The more the client stays engaged, the more the advisor will stay engaged.
Well, and we come off, you and I sometimes can come off a little flippant because you want to answer the question. You're getting asked a question. We appreciate the chance to present. But there's times where you get a question like I said, what did you do in one particular year, 15 years ago? And it's just irrelevant to any longer term sort of expectations of what a client should do. I don't know. It's my 2 cents for it.
Well, like I said, it's funny that I mentioned, a dating app earlier. It's the same sort of thing. There are some questions you want to lead with, some you don't. And this is one that I think is not a question that you lead with, because if you haven't taken the time to understand the rest of how they got there, then the number by itself is totally irrelevant. But that's our opinion, right? I mean, that's the point, right? We're just giving you our take on this process. So, I mean, in the scheme of things, you had asked me a question a couple of weeks ago, and I thought it would be an interesting one. You want to fire away and do that in this podcast as well?
Yeah, it was on one of the market commentaries, and we'll put in the show notes a link to that landing page so you can sign up if you're not already a member. And essentially, I was on Microsoft Teams messaging you, and I said, hey, past 20 years, what's the best performing asset class? The S&P 500, emerging markets, gold, or real estate?
Yeah, well, I'm smart enough to know that if you ask me that question, it sure shit isn't going to be the U.S. market. So, I mean, I've been in the business since 1995, and I seriously I had a hesitation. I was like,
Yeah, but hold on. I asked you in December, and recency bias is a real thing with annual returns. The S&P was up 31%. So
yeah.
I know you didn't want to answer U.S. stocks, but I think you might have.
No, I think I did like emerging market. I thought, all right, let's give that a whirl.
Which
I
was
mean, it was really
last.
a throwing darts. Yeah, well, there's a reason that. Yeah, so
Well, anyway, the point is, bringing
by
it back
now,
to topic,
advisors who
right?
are listening or watching to this should have already in their mind the wheels are turning. The little mouse is like scurrying through there, and they should have formulated some sort of an answer. So I
Well,
think
all
it's
right. So
fine now.
look, I mean, it's real estate by a long shot. Believe it or not, gold and the S&P 500 are almost identical in terms of performance. If you do just the price of the S&P without total returns, because gold obviously doesn't have any dividends, gold I think is slightly better. But the point is, if you pick on one or two, annual return numbers that you're fixated on, you'll miss something like that over a 20-year period. The
Right.
flip side to that is something like Europe, which we kind of mentioned in that same podcast, where it's been 20 years and the return has been zero. But you can point to any number of years, and you had an example with the S&P as well, right?
Yeah, yeah. So I thought this was funny, just the way as we're talking about calendar year returns. So I did a little research, and if you look at the first day of the year, January 3rd, 2000, the S&P total return was 1455.22. All right. Now people talk about the lost decade, and we used to have a marketing piece about that. But if you go all the way to January 2nd of 2013, the first opening day there, it was 1462.21. These are from Y charts. So that was the first day after it never touched that 1455 spot again. So it's just a little bit ironic that it came out to be the very beginning. So you can look backwards, right, at the full calendar years of those 13 full years, and you got nowhere. And
Yeah.
that's the S&P 500. We're in a historically long bull run, right? Most of that period was, in fact, bull run. But I mean, it is what it is, right? The numbers don't lie. It took a little bit to do find the data, but sure enough, it just happened to be the beginning of those 2 years is where you find that line, and
Yeah.
it got a little bit above, and then it'd fall back, got above, fall back, and look, that's what we really want, right? We want to find somewhere and then just keep going forward and not keep retreating. So, yeah, that's just a little bit of an S&P throwback for you.
Yep.
But anyway, all right, let's sum this up a bit. I mean, ultimately, what we're trying to say, right? The question of calendar year returns, by itself, is not a very valid request.
Well, here
You need to have some
let's take
perspective
it
around
to
it.
from a, yeah. For let's perspective is the best word you could put right here. From a money
Yeah,
management perspective, I talk to people all the time, where whether it's advisors or other managers, and they'll bring up one point, for example, the percentage of stocks below their 200-day moving average. Let's just pull that out as an example. Great. It's true. Your data may be true and it may fit your narrative, but it's absolutely pointless because there's about 500 other things that you should take into account. And so it's the headline bias as well, right? Something happens. Manufacturing declines, unemployment. Same thing. This is the best analogy I can come up with. Same thing with calendar year returns. It's one headline that is meaningless to the entire picture. It's meaningless to your client's financial plan. It's even more meaningless to future returns, and what the expectations in the process should be. So,
yeah,
don't ever focus on one item, regardless of what you're looking at.
yeah. Well, and right now it's coronavirus. Ooh, hey,
Yeah.
it's kind of a scary thing psychologically. Yes, it's a scary thing, but look, until it affects the data, there's no investment, and I think you're silly to try and take some investment target to wade through the waters to figure out how to go around the coronavirus. I mean,
But
haven't
let's.
done anything yet.
What do you think? They're completely lying about the data? Because I do.
It's hard telling. I mean, look, the cruise we just came off of a few weeks ago. I mean, there was, and at first I didn't realize it because I hadn't noticed the corona stuff before we got on the cruise. And then afterwards, I got the news and realized this lady was wearing glasses that were about this big. Yes, she was of some Asian descent, so just a ballpark, right? She's got these huge glasses and a mask thing that went all the way down, halfway down her chest and wrapped around her ears. And this was ready for an outdoor entertainment event. And I was like, wow, I mean, that's going a little bit extreme. Well, like I said,
Whatever,
once I got back
dude.
to the boat, I realized it.
If I get on a plane, I'm putting on a fucking hazmat suit and a full like, Resident Evil ventilator.
You're gonna look like the Stay Puft Doughboy. All right,
around.
hey, let's move on. All right, recommendations. This one isn't gonna help you out at all, bro. Have you looked to see my recommendation?
No, I don't know what you're even talking about.
It's Tree Shampoo.
It's barely helping
I love
you.
this stuff. Hey, it's not meant to grow hair back, but you got to have some to use it in the first place, and I have just a little bit. So anyway, yeah, I've used this before, and then I kind of skipped it for a long time. And if you have any sort of dry scalp or whatever, even if you don't, it's a very tingly, invigorating shampoo. I really love it. I started using it again, and I forgot how enjoyable it was for a simple task like shampooing your hair.
And invigorating.
There you
just
go.
got dropped. All right, cool. So my recommendation, I'm not a big reader. I read trading books and dorky things like that with the market, but I don't ever really pick up a random book about nonsense. So, but this book got recommended to me. It's called The Book of Life by J. Krishnamurti, and it says daily meditations.
Hold that up there again. I think the reflection tilted a little bit so we can see it. There you go. All right, it's just a lot of white. All right, that's cool.
And so, I mean, it says daily meditations, but it's not really a meditation thing. It's just like a daily, I don't know, saying or sort of short story about life. And I don't know, as I age and have kids, I'm starting to be weird with this kind of stuff. So it's a good self-reflection book, I guess, if you're into that stuff.
Gotcha.
And it has like a story for each day. So January 10th, 11th, 12th, you open up and whatever. So I got it from a podcast, Naval, which I follow. And so I think it's a worthy order. It's like $12 on Amazon, and we'll put the link in the show notes. But that's all I have for this week. Yep.
All right. On that note, hey guys, we men and women. I shouldn't say just guys. I hate using that phrase. All right. So anyway, advisors, thanks for listening. Certainly like, subscribe, give us a call. Ask me about calendar year returns. Anyway,
ask Jeff how we did last year.
Yeah, exactly. How do we do? Freaking wonderful. Anyway, that said, we're out. Thanks a lot for listening. We'll talk to you next time.